Hello and welcome to an educational video brought to you by Bayntree Wealth Advisors. My name is Cristina Perez and I'm a certified financial planning professional here at Bayntree. Today I'm here to talk to you a little bit about market volatility and some of the best practices to help navigate it. Let's get started. First, a general disclosure. This video was made for educational purposes only and should not be seen as specific investment advice since we are not taking into account your personal and financial circumstances. So what is market volatility? It essentially is the frequency and magnitude of price movements in financial markets. It tells us the amount of uncertainty or risk there is in the market. But it's extremely important to keep in mind that market volatility, which just means the ups and downs, is to be expected and a normal part of investing. I'm sure you've all heard the expression, you have to risk big to win big. And that's essentially what you're doing when you have a higher stock exposure. That essentially means more risk, which also means more volatility. But therefore, the longer you have until your retirement or expected need for the funds that you're investing, the more risk you potentially can take on. Other factors will include your personal income needs and financial circumstances. So there are three main drivers that impact volatility. The first are going to be economic indicators, which is simply the data that is used to measure and gauge the health and trends of an economy or even a specific industry. One that might be familiar is GDP, which stands for gross domestic product. The second main factor is going to be global events. So geopolitical tensions and conflicts around the world can also create uncertainty and influence market swings. And lastly, investor sentiment, because at the end of the day, we are all human and we are the ones investing in the stock market. Therefore, psychology, such as fear and greed and other emotions, play a role in amplifying market volatility. The main index that is used to measure and track volatility in the markets is known as the VIX. The symbol is VIX, and it essentially is a real-time index representing the market's expectations for volatility in the next 30 days. The higher the number, the higher the risk. So there are three ideas or best practices that we would highlight for times of market volatility. The first is ensuring that you have a diversified investment strategy. That is one of the ways to minimize market risk. The second is to keep a long-term perspective, understanding your personal time horizon to invest and understanding how much and when you are going to start to need the funds. That should help you inform your investment strategy and how much risk is appropriate to take. And lastly, it's good to always plan for the unexpected, which means having adequate emergency savings. The rule of thumb is 3 to 6 months. For self-employed individuals, that might actually be 9 to 12 months. In addition, it's important to ensure that you have appropriate insurance coverage, disability or life insurance, or even understanding your health insurance coverage or what would happen if you, let's say, lost your job. So those are things that we would recommend reviewing, especially during times of market volatility. And this graph really just highlights the point that we were trying to make, that market volatility is normal. Historically, this graph shows from 1925 up until 2022. You'll see there have been major global events and volatility all throughout this period. But historically, the trend, of course, shows that it has gone up each year, or not each year, but up in general. And it's important also to keep in mind that historical performance is no guarantee of future performance. Two additional things that we would recommend looking at is rebalancing your portfolio during these times. For retirement accounts, you can really rebalance at any point and reallocate without having to worry about causing any capital gain liabilities. But with any non-retirement accounts, this could be the best time to make those changes. And also buying the dip, especially if you have a long time before you plan to retire. It's good to see the lows in the market volatility as a good buying opportunity. It's counterintuitive, and especially for those folks that are nearing retirement, those lows are not seen as opportunities the same way as a younger investor with a longer time horizon. Again, this was made for educational purposes only, but if you would like to discuss with us your exact personal situation so we can provide further advice and recommendations, this is our contact information, and you can definitely feel free to reach out. Thank you and have a great day.